Hello and welcome to this week's edition of Echo45 Advisors Market and Economic Update. In this video, we'll discuss recent market volatility, the current state of the bond market, and why maintaining a well-balanced portfolio continues to be the best approach for long-term investors. Over the past few weeks, rising oil prices and the ongoing conflict in Iran have been the primary drivers of market swings. Periods like these remind us of the quote, "Do not confuse motion with progress." These headlines can make it feel like constant adjustments to your portfolio are necessary. But as we'll discuss, a well-constructed portfolio is designed to weather exactly these kinds of environments. Over the next few minutes, we'll walk through each of these topics. First, let's put recent stock market volatility into perspective. The S&P 500 is currently sitting just under 5% below its all-time high from earlier this year. While that can feel unsettling, pullbacks of this size are a completely normal part of investing. In fact, the average year sees several declines of 5% or more before the market rebounds. Just last year in 2025, there were 6 such pullbacks driven by tariffs. Yet the market still finished the year with an 18% total return. This chart illustrates an important point. Historically, even missing just a single week after volatile days has historically hurt investment outcomes. That's because the market's best days have tended to follow closely after its worst days. So investors who moved to the sidelines often missed the very rebounds they were waiting for. The takeaway here isn't that pullbacks don't matter. It's that they are a recurring feature of investing that should be planned for and not reacted to. Next, let's talk about bonds. Higher oil prices have raised fresh questions about inflation, and there's added uncertainty around the upcoming transition to a new Fed chair in May. Right now, markets are pricing in only one rate cut for the remainder of the year. These factors have kept the broad bond market roughly flat so far this year, with the 10-year Treasury yield climbing back above 4.2%. However, some perspective is helpful here. Bonds have actually recovered since their historic pullback in 2022, generating roughly 20% in total returns since that low point. More importantly, bond yields today are genuinely attractive compared to much of the past decade. The yield on the broad U.S. bond market is currently 4.5%, well above its average of 2.9% since 2009. This chart looks complex, but it's actually quite simple. It shows that investing when yields are at these levels has historically been associated with strong total returns going forward. It's also worth noting that cash isn't necessarily the safe alternative it might appear to be. After adjusting for inflation, cash yields are still negative, meaning that inflation continues to eat into purchasing power. A proper allocation to bonds remains a more effective way to generate income and support long-term growth. Finally, these past few weeks are a good reminder of why portfolio balance matters so much. Holding a mix of different asset classes, whether that's stocks, bonds, commodities, or investments across different parts of the world, helps smooth out performance during choppy periods. This chart looks back at one of the most volatile periods in recent history, the early months of the pandemic in 2020. Portfolios that were more balanced across asset classes experienced smaller swings during that period. The key question isn't just how a portfolio performs on paper, it's whether investors are able to stay the course. Today, asset classes like commodities are providing some balance as energy and precious metals lead the way. But the goal isn't to predict which asset class will outperform next. It's to build a portfolio that benefits from the full range of market conditions. When one area struggles, another can provide some stability. We hope you found these insights helpful. If you'd like to discuss current market volatility, bond yields, or your overall portfolio strategy in more detail, please don't hesitate to reach out. We look forward to speaking with you.